Welcome to the Deep Dive. We sort through the noise, find the key insights from stacks of sources, and give them straight to you. Fast track to being well-informed. Today, we're jumping into a really fascinating and honestly pretty fast-moving area of finance. We're going to look at how those exchange-traded funds, ETFs, which many of you probably hold,
Right.
how they're intersecting with something much newer, these 0 days to expiration options, or 0 DTEs, our goal. Give you the quick rundown on this, especially these new Daymax ETFs that use them.
Yeah, it's definitely a hot topic. And it makes sense to start with ETFs because, well, they're everywhere now, aren't they? Fundamentally, an ETF is just an investment fund, but it trades on a stock exchange.
Yeah.
Just like, say, Apple stock. People love them for diversification, usually lower cost, transparency, all that good stuff. I mean, globally, we're talking over $5.1 trillion in ETF assets. They're a huge part of modern investing.
Okay, so ETFs are kind of the established players. Broad exposure, diversification, maybe more of a long game mindset for many investors. But then you have these 0 DTE options, and their rise since 2022. It's been called meteoric, and that's not really an exaggeration, is it?
No, not at all. The growth has been explosive.
We're talking trading volume up more than 5 times, easily over $1 trillion in notional value traded daily. That's huge.
Right.
It feels like a real shift, especially for you, the retail investor, getting access to these kinds of tools. So what really makes them tick? How are they so different from a standard ETF approach? And, why are we seeing these Daymax ETFs pop up now, specifically using them?
Yeah. Well, the name 0 DTE, 0 days to expiration, it's actually very descriptive. It's an option contract that literally expires at the end of the current trading day. Gone. Doesn't trade anymore after the close. Now, technically, every option eventually reaches its expiration day, its 0 day. But when we talk about 0 DTEs in this context, we're specifically referring to options on the big guys, major indices, and their ETFs. Think SPY, that's the big S&P 500 ETF, or SPX, the index itself, same for the NASDAQ 100, the NDX index, and the QQQ ETF. The big change came in 2022 when the CDOE started listing options on these that expire every single trading day, Monday, Tuesday, Wednesday.
Wow.
Every day became an expiration day.
Ah, okay. So that daily expiration schedule is the game changer. So if I'm mapping this out for you, the listener, traditional ETFs, generally broad, diversified, think longer horizons than 0 DTE option, ultra short term, like blink and you miss it short term. They expire today.
Exactly.
And that must come with some pretty unique traits, right? Like I've heard about accelerated time decay.
Oh, absolutely. Time decay, or theta, is always a factor for options. But with 0 DTEs, it's on hyperdrive. Imagine an ice cube melting on a hot sidewalk. The option's time value just evaporates rapidly as the end of the day approaches.
And price swings must be amplified too.
Definitely. You get much higher gamma exposure, meaning even small moves in the underlying index or ETF can cause really big percentage changes in the option's price. It's like a lever magnifying things.
So these Daymax ETFs, they're essentially taking this very active, very short-term options strategy and packaging it into an ETF format, using these 0 DTEs to try and generate income daily instead of, say, monthly, like older option strategies.
Precisely. Instead of maybe 12 opportunities a year with monthly options, you potentially get around 250 trading days, 250 opportunities to collect premium by selling these 0 DTEs.
Right. Okay, so the potential benefit there is that daily income generation. More frequent chances to collect premium.
Yes, that's a key draw. The potential for daily premium, which could enhance overall yield. Plus, some strategies might give you exposure to overnight returns, too, which is interesting. It sort of democratizes these more complex income strategies, brings them into reach for more people via an ETF.
And there's always a but in finance, isn't there?
There is.
This speed, this leverage, it comes with risks, surely. Higher volatility.
Absolutely. Options inherently involve risk. And these ultra short-term ones amplify certain risks, particularly that sensitivity to sharp, sudden market moves.
Yeah.
Volatility is higher. And there are nuances, too, like settlement. Index options like SPX usually settle in cash, European style, meaning they can only be exercised at expiration, whereas ETF options like SPY typically settle in shares and are American style. They can be exercised anytime before expiration. Small differences, but they matter in practice.
Okay, that makes sense. It's definitely not a simple landscape. So wrapping this up, maybe a final thought for you to consider. As these 0 TE strategies become more popular, potentially packaged in accessible ETFs like these Daymax ones, how might that change things, for retail investing habits or even for the overall choppiness, the volatility of the market itself in the coming years? Something to chew on for sure. It's a space that's definitely worth keeping an eye on.